So in order for us as a bank to give them metal financing, we would go in and we would borrow metal. Well, actually, we would borrow dollars and then we would borrow metal and we would give them that metal for a period of time. And by borrowing that metal, we're actually locking in that contango, and that contango serves as a reduction/discount to their cost of financing. So when a bank evaluates, using the same credit spread across multiple products, being able to finance in metal often tends to be far cheaper than it does with financing in dollars.
And the futures market affords the bank that opportunity to be able to discount that interest to the customer. And so, for those listening, the role that the bullion banks play in the industry is immense, because the amount of inventory that, a company like ours or any of the big precious metals companies is holding at any given time can be enormous. So the interest rate, the carry cost of a lot of that inventory can have a huge impact on profitability. So if we can work with the bullion banks to help discount that interest rate, it's imperative for us to be able to have the amount of inventory we need to service the marketplace. So you mentioned that this year in particular has been wild and crazy. We were talking before the podcast saying that, as you talk to your banking friends, it's like, when is this going to end? Because with the tariffs and the wild swings in contango and the carry trade and the tariffs and everything that's happening in the global markets, it has been a real struggle. So talk us through that process over the last 6 months.
I don't even know where to begin. I mean, the reality is it hasn't been 6 months. It really started when President, then nominee Trump, was on the cards for a second term. Because what he does better than most is introduce volatility into the system. And that volatility, it started as a positive momentum heading into the election and heading into year end. But the reality is, as the narrative started coming through on tariffs and approaches to international strategy and diplomatic affairs, he left so little clarity on the table that people didn't know how to manage their risk. They didn't know if they would have availability to metal, to ample supply to be able to address their client base. So typically when a bank, in a natural position, a bank is constantly long physical metal in order to be able to give that to their clients. And as a hedge against the physical metal, they're short futures. And there's multiple ways that they can address those futures positions. But one of the ways that they tend to do that is to be able to bring in metal from London, which is the larger OTC exchange equivalent platform that banks deal with, and ship it internationally to New York and settle their obligations on futures. And when President Trump came into the picture and started speaking about potential tariffs, people didn't know whether or not that would extend into the bullion world. So they didn't know if they would have that supply of bringing metal in at the same cost as before and closing out those positions. And that's what introduced that uncertainty and led to a lot of volatility that we have seen in the last, since January. It is really when it kind of started, or actually mid-December, and it hasn't stopped since. There was a period of respite, which we figured it's summertime, everybody wants a break, but now the tariff discussions are back on the table, and it's just opening that lack of clarity again, opening that confusion and having prices and lease rates be all over the place.
Are you always trying to keep a sort of a neutral exposure to the market, or are you taking long and short positions on behalf of the bank?
So we are usually holding inventory, depending on what we think our clients will need at any given time. And our positions are driven by that. So it just depends, if we have clients in the US and we think that they're going to need high purity silver, we're going to have more of that. If we have clients in Europe and we think that they're going to need sponge platinum palladium, we hold more of that. So all of our trading is driven around having inventory available for our client needs.
But that inventory is on your balance sheet, but that doesn't necessarily mean that you're taking full exposure
Correct.
to the price movement.
Correct.
So are you trying to keep your price exposure at par, basically taking note? Let's say it's silver and you have $10 billion worth of silver on the balance sheet. Are you taking 10 billion in short positions on the other side to price out the risk, or are you taking long positions or short positions in the market? How does that work?
We typically look at spreads, whether it's month-to-month spreads or whether it's location spreads, that we will look at those fundamental deviations. But we do have really tough risk parameters in terms of what we are able to take risk on and what we're not able to. So whatever we are able to put on is usually driven by market risk, by liquidity, by availability to financing and inventory, by exchange limits, et cetera. So typically we will hedge most of our positions, and then we'll trade around that as needed.
Okay. I recently saw on X some data that stated that the banks are net short 50% open interest in silver. We already know that we have a structural deficit in silver. What does that mean, and how should people look at that as it relates to price? I mean, silver has skyrocketed. It's up, another 15% in the last couple of weeks, and yet the banks are 50% net short open interest. How is that to be interpreted?
I think that ultimately you have to look at it as a combination of your futures positions and your OTC/physical positions. So just because a bank may or may not be short on the futures doesn't mean that they're short across the board. It typically means that they're long on the physical end of it. And the reality is, like you said, it's in a deficit because there is demand there. Mm-hmm. So we're constantly long that physical because our consumers want that.
So another way of interpreting that is it is very likely that the amount of metal on the bank's balance sheets is higher than normal, and that's being reflected in the net short position.
It could be on any one given metal, but you would have to look at all the metals combined in terms of what the net position is, right?
So this tariff question remains hanging over the head of everybody in the industry. Do you have a perspective on how you think this will play out? Do you anticipate that over the next couple of weeks things will settle down? You mentioned it's like a respite that we had a couple months ago, or I guess I'm curious what the water cooler talk is.
I think that for better or worse, we had the COVID pandemic experience in 2020, and it was a situation that had never been tested before, kind of like a fire drill. What happens if you need to exit the building? In this case, it was what happens if you don't have access to the metal that you need. So I think that banks, financial institutions, merchants were able to learn a lot from that time. And this time around, they were able to move far quicker. And you notice that in the way that the EFP traded and the forwards traded, and the time that it took contracts and rates to right size again. So I think that, look, as long as President Trump has not finished his negotiations, then anything is on the table. When those completed discussions emerge, I think that's when things will calm down. It would be handy, there's still inconsistencies as to whether or not investment grade bullion is entirely tariff proof. So that would help if that was addressed. But I think in general, the market will calm down again once focus pivots to something else other than tariffs.